And welcome to the show. First, I'd like to start off by wishing everyone wonderful holiday season. I hope everyone's gotten some time to spend some time with your loved ones, relax a little bit. So happy holidays. And of course, it's going to be a happy new year pretty soon. We're here with Rob Tatro, Portfolio Manager with Tatro Wealth Advisor Group, myself, Tanya Tatro. Rob's big sister and business partner. And today we're doing a little bit of a market wrap up for the year. We're going to chat a little bit. We're going to take some questions. So for those of you who are live on YouTube or Facebook, we're going to be waiting for some questions from you. And we're here to answer any questions you might have and do a little bit of a recap. So Rob, how's it going?
Things are awesome, Tanya. Things are really, really good. It was a great year. 2023 was a great year all around. Business for the clients, for my family, for myself. It was just a great year. 2023 was a fantastic year.
I agree. It was a fantastic year. A bunch of just amazing projects too that we had with our family as well. I don't know if we'll have too much time to talk about that, but we can chat a little bit. And
Which ones
I
specifically are
don't
you thinking
know.
about?
I'm thinking about like kind of like highlights of the year. If I think about kind of highlights of the year, Run with Rob, our philanthropic effort was a big one. That was a highlight. And just as far as just a great year for the family, I feel like.
Yeah, for sure. And our dad's recovering fairly nicely from his chemo treatments and his non-Hodgkin's lymphoma, ALL, stage 4 non-Hodgkin's lymphoma. So it's good to see
Hmm.
him. He was here at the Christmas party last week, and he actually won the. We were playing this. What's it called? Fibbage, or one of these games that you play on the TV, where you put in an answer and you try to get. Anyways, we're playing like as a group, and he was crushing it. So it was good to see him sharp and having fun and laughing.
Yeah, I
Uh,
was very impressed. I was impressed by that. It was really nice to see. The other thing too this year that's been really nice is it's been nice to kind of see the markets come back. There was, the year before 2022 was a rough one for I think for a lot of investors, and so this year is just really kind of nice to see just kind of getting out of that rut a little bit and watching things move in the right direction seemed
yeah,
good.
I watched our video from last year. We did one around this time. It was a little earlier, but I watched it last year, and it was no. I don't want to say the mood was different for sure, right? Because we were coming off the seventh worst year in the market, and we were optimistic. I kept saying, and it was fun to watch because looking back, you're like, we were right on all those things that we called. Not because we knew what was going to happen, but just because we used historical data to, I guess, guide a lot of our decision making and to how to remove emotion from the process and stuff. And it was cool to watch that and then to look at it now and to see we did good for clients, and that's always fun too, right?
Yeah, and it's nice, even though we can't predict things, we can't, call the bottom or whatever it is. It's nice. It's satisfying, as my son would say. He loves saying that whenever like he does something, he accomplishes. He says, "Oh, that's so satisfying." I feel like it's like that in this case. Like it's satisfying to know, that we did well by clients and that they did better this year, and that even though everyone else was freaking out in 2022, that we kept things on the up and up as well. So really happy about that. That part's satisfying, as my son would say.
Yes, definitely satisfying. And remember to put your comments if you're watching on Facebook, if you're watching on YouTube, if you're watching on wherever else you might be watching on X or Twitter or LinkedIn. Put your questions in there. We will see them here, and then we can kind of answer any questions you may have. I'm going to start though. Well, no, how about before that, Tanya? Uh, what are your Christmas traditions that you
Uh,
value?
okay, Christmas traditions. I love this. This is awesome. So we have this thing that we do with our family where my husband actually does a full on poetry scavenger slash treasure hunt for all the presents for my son. So he literally will write rhymed out poetry clues for my son to go find all of his gifts
So
throughout the
Marius
house.
has to put some work in if he wants to open some gifts.
That's right. But his dad also put some work in, actually writes out rhyming clues to do that. So this year we actually didn't quite follow the tradition. We only did it for a couple of gifts, and now I'm like, oh, I'm disappointed. I think we should keep doing that. How old do you think is too old to do treasure hunts and scavenger
Oh
hunts
my
for your
God.
kids?
I'm pretty sure my 15-year-old would still do that if we did it. So I think that's a great idea. I love
Yeah.
that.
Yeah, and then another tradition, of course, is everyone has their Christmas movies that they like to watch, right? So we do Home Alone and Elf. Those are our big
Home Alone
favorites.
1 or 2?
One.
Yeah.
Well, we did 1 and 2 this time, but yeah.
I feel like I've seen him each 3 times this year. My kids are Home Alone fans, and it's like the younger ones now are more into it than the older. I have 4 kids, so like the younger ones are more into it than the older ones, but they're still like in the meat and potatoes age of loving Home Alone. And it's a great flick to put on, even if you're not watching it, to put on the background if you're like making a dinner or if you're whatever. Um,
I just
but I
found out
mean,
something really cool piece of trivia on this. Did you know
okay, let's go.
that the movie that Kevin watches that he uses
Yeah,
to
they're
save,
fake movies.
that's a fake movie. I did not
Yeah,
know that. You
Fallen
filthy
Angels.
scoundrels. Yes, Fallen Angels. I didn't
Yeah,
know that. That's a fake movie that they did just for this.
yeah, I'm a bit of a trivia buff when it comes to these two movies because I've watched the documentaries, I've watched the shorts, I've watched the interviews, I've read the books on Home Alone, so I know my Home Alones a little bit. Uh, like $15 million budget, they shot it in a gymnasium. It's crazy. Like they never really knew. Anyways, it was like a 10x, 20x, or 30x, I think, moneymaker for them.
Yeah.
And obviously, pretty easy to forget your kid twice in a row, right? Like
Great story.
story
Really realistic storyline. Yeah.
storyline not stretched at all. Yeah. Um,
What about
yeah.
yours? Tell me about your traditions. I
Archer. Well,
mean,
I love the Réveillon. By the way, put your questions down there. We're talking a little bit about Christmas, but I love Le Réveillon, French Canadian tradition, where you go to Manon, Adrienne, ma tante Claire's,
yeah.
which used to be ma mère and papa's, grandma, grandpa, and then they sold their house, and obviously my aunt and uncle kept the tradition going. So that's midnight mass, and then you go for the party afterwards, and the meal is
Yeah.
extravagant and
The
like
late night, midnight
late night
dinner. And
dinner. The kids are playing all sorts of games. The adults, and there's a lot of kids, and the adults are playing cards or puzzles or crokinole or anyways, and we have a good time there. And the party ends at like 3 in the morning or whatever. And it's kind of like I always tell my kids, there's no rules tonight.
yeah.
You can have as many chocolates as you want. And my wife's like, well, there's got to be rules. I'm like, no, there's no rules. This is the one night where there's no rules. If they want to drink pop, they can. We never drink pop in our house, so and then they're wired the next day, and then we go to the 25th. We host at our house for Michelle's side of the family. So then she's like, all these kids are wired, and it's all your fault. And yeah, it kind of is my fault. But Christmas for me, by like 20 times more special than any other holiday for me growing up as a kid. It was the most important and precious thing. I got to see all my cousins. We played a ton. Remember, we used to spend a day or two at Mamaz. We'd spend like 1 or 2 nights
Oh,
there, and we'd
you'd
play
fall asleep
football
on the
outside.
couch
And
and you'd wake up in the
and
morning
there's
and
a
just like
party
eat all
still
the
happening.
leftovers. Yeah. Oh,
And
it's
then like
some
the
of
the
the best
dads were
memories.
playing chess, or they were playing cards, or they were playing all these. And then some of you guys, you and Mitch Durant or whatever, would make these like different rallies or these different games, and we'd break into teams. And the cousins, we had huge families, so it was cool.
Yeah.
So that's my favorite tradition, and I'm glad it's not dying.
Well, that's the thing. It's in danger of dying, as families get smaller, and the extended families kind of start to kind of each go their own ways. So if we can save those kind of bigger extended family traditions, yeah, that's some of the best memories I had for sure as a kid. Oh,
Yeah, and we'll get into charts here real quick. I want to show you a couple things, but the last thing I want to say is I had a crazy year in terms of running. For those that don't know, I did 31 half marathons. I did three.
is
Iron, that
that's not just
includes
run
that
around what
include
includes
yeah, yeah,
running
no,
with
it
Rob
includes
and
the
some
20.
others.
Yeah, I
Okay.
did 7 others, but
Okay.
I did 31 in total. Three Ironman and three Iron Men. Three Iron Men. Do you conjugate that?
I
Three
think
Iron
it's Iron Man's. I actually think you would do that.
Ironmans.
Yeah, I think that's how you would say because it's like a title.
All right, so
I don't
three
know.
Ironmans, and then I did 2 ultras as well, which was just a crazy year to think what our body's capable of doing. And this morning I was thinking on my jog, I had to do a like a tempo jog. I had to run uphill at 7% incline, and I had to do that for a minute at 5.25 minute miles, which is like it's really fast for me. And I was thinking how far I've come and how I couldn't do the workout. Is one of the first times in months, if not years, that I couldn't actually do the workout as my coach had prescribed. And I was just
Wow.
like, you know what? That's okay. I'm not going to sacrifice good for perfect.
I
Is
would
that
have thought
you?
that eating all of the, like Christmas food and treats would give you like more energy and make you like,
In
you know,
fairness, I did do like 80 kilometers over the last 5 days, because four
yeah.
days, because I had nothing else to do. Because like I was just like, I'm gonna go out for a half marathon. So like last night I came to the office and I did. So quick story, we had a flood in our office, so we got moved to the 12th floor temporarily for like 6 months or something. So we're no longer on the 10th floor for a few months, and we have now the whole floor. So there's a lot of space, and I
It's
always
wide open.
it's wide open, and there's enough room on the outside, like it's kind of like a track. So I always said, oh, it'd be cool to do like a half marathon or a 15K or something. So last night I came to the office and I did 15 kilometers. Just
What? No, you're kidding me. You did this last night?
yeah, I didn't do a half or anything, but I wanted to see what it was. I did 100 laps of the office. Anyways, so that was fun.
So is it
Uh,
doable, do you think, to like do a long race like
oh,
that?
for sure. I had a
Do you
great
get
time.
dizzy? Does it like an
No, because it's big enough. So this is our building, this building that I'm in right now at Portage in Maine, and I ran along the windows all the way around, and I figure it's about 140 meters roughly is the loop. So it's like a short track. If ever you go to like Sport for Life Center, it's roughly that length.
Yeah.
Um,
Well, that's amazing. My training's been a little bit different. Mine's a little more, I would call it diversified than your training
I
is. I
do
feel
strength. I lift some weights, Tanya.
I know. I still think mine's a little bit more diversified. So you know what?
Why?
I've
Why
been
is
working.
yours more diversified than mine?
Well, because I not only do I do more different types of strength, but I also do quite a bit of this is what I've been working on this year as actually hand balancing and kind of certain types of circus arts.
Okay, fair
So
enough. Yeah,
that's
yeah, yeah.
yeah.
So I
So
have like, if we're looking at a portfolio, I have like
yeah,
70% stocks, which is my
yeah,
running, and like
yeah,
30% alts,
yeah.
which is my weights.
That's
And
right.
you
And
have some fixed income, you got some private debt in
yes,
there, you got some
I've
private
got
we
at least 3 asset classes in there,
yeah,
at least. Yeah,
fair enough. And I only have two asset classes.
yeah.
Yeah.
So
Okay,
there
I'll
you
give
go.
you that. I'll give you that. You didn't think you'd get an asset allocation joke in your Christmas stock market recap, year-end review. Um, I thought I'd start, or I don't know where we should start, but since we don't have any questions, I'm guessing people are either. I know there's a lot of people watching right now. I could see how many people are watching, but I guess they're either like. So I know some clients have sent us questions. Some people have sent us questions, and I know I got one question about kind of maybe we could start about kind of forecasting
Yeah.
2024 or
Or do we want to do like a little bit of a wrap up of like
sure,
big picture what this year was like?
sure.
I also think that maybe we can't really have a recap of this year without talking a little bit, at least, about the Magnificent Seven. Maybe just talk a little bit
Yeah,
about kind of the major indexes. This is something I don't know if my grammar is correct on
indices.
that. Indices. Okay.
Yeah. I think
So
indexes is okay too.
I don't know if we should worry about our grammar now. People know what we're talking about anyway. So
Indeci?
I think it's
No, forget
indices.
it. I know. It's,
All right. So you're in review. I mean, certainly a much more optimistic than 2022, and not just optimistic, but actual results. Should we look at some of the numbers?
I mean, I was way more optimistic a year ago as to what the next year would look
Yeah.
like
Yeah.
than I am today. I mean, I'm still optimistic for a whole bunch of reasons, but last year I was like, we are at a bottom here, a mini bottom
Well,
anyways.
yeah, and for sure now we're much closer to all-time highs, and so it's always a little bit tougher to be looking for another, you know, double-digit return years when we're already kind of so
Yeah, but you
close,
know
right?
what? Yeah, but that's a common misconception because it's actually a bullish sign. A new
Hmm.
all-time high is a bullish sign because if you look at every new all-time high that's ever been made, and you look at the 12-month future returns from that specific spot, the average is better than if you took any random day. So if you took any random day and you
Okay.
said, what's the market a year high, or it might be, I don't know, 8% or 9% in the last 40, 50 years. I think it's closer to 10% if you go, 100 and something years. But if you take just the days where the market has done an all-time high, it's closer to 12
Okay.
or something like that. I remember seeing that chart. I don't have that one in front of me, but I think that's it's actually a bullish indicator.
Yeah.
All-time highs is a bullish indicator because highs beget highs.
Yep. And of course, markets are generally kind of pricing in whatever intuitions and kind of forecasts or that are that are kind of floating around, especially now. I think we may even have a chart for this, but especially after, the Federal Reserve kind of gives some optimistic speeches over December, it kind of helps that Santa rally a little bit more even.
Yeah, so there is a question here coming in from Jean about 2024 forecast. I don't know if we should start there. We'll get to 2023 in a sec. Why don't we start with this question here? Jean is asking us 2024 forecast. So I expect, by the way, this is very tough to do and very tough to predict, but historically, if you look at a year like we've just had prior year, so we're in kind of the fourth year of an election cycle, which is typically an okay year or a good year. The third year from the election cycle is actually the best year, the U.S. election cycle, let's say that. If I look at here, I'm going to share a chart here. Come on, Rob, you can do this. No. Share screen. Yeah. So if you look at the...
There we go.
I'm just going to zoom in a little bit, but what is this, 7 or 8 times where the market's gone negative big. So in other words, a negative cycle followed by a rally. And this is what we had in 2024. What does the following year look like? And it's very muted, but it's very consistent, right? We're looking at anything from 8 to kind of 19%, with the average being about 11.7, the median being about 11, and the actual percentage of positive year being, very likely. Now, I know that this doesn't take into account every single factor that's happening today, but it's a good reminder that although we've had a really good year, there's still meat on the bone. There's definitely still meat on the bone. And I think that we could see something like that. I don't think we'll see a 30% return. I certainly don't think we'll see, a minus 20 like that. I don't think that's in the cards. But I think anywhere from like 5 to 15 would be kind of generally what I think we'll get in the US. Canada is a lot more cyclical, and it's a lot more dependent on what happens with our oil and gas and what happens with our materials and stuff. And then I just want to show you another chart here, 52-week high in key cyclical industries. I'm going to show you this one. So this is 4 different key cyclical industries. So we're seeing home prices, we're seeing, I got to get these, the steel indices, the Russell 2000. So this is home buyers, Russell 2000, steel, and semiconductors. So the 4 indices are at or close to all-time highs, and these are bullish signs generally in the cycle. So here's another one I wanted to share with you, and I think that, this is another. I'm just gonna keep sharing you we're now in the 8th positive week for the stock market here, 8th consecutive positive week. The last 7 have been positive. It looks like this week, it's a day in, 2 days in. Remember, the market was open yesterday in the US, not open in Canada, but open yesterday in the US. Here's the history of the 7-week streaks, 7-week win streaks. Although we would think that the reversion to the mean is likely something that will happen, if we actually look at, come on, Rob, zoom in. No, it's not letting me zoom in. There we go. If we actually look at the market 1 month out, 3 months out, 6 months out, or 12 months out, we're looking at about 80 to 85% of those being positive, with some really nice positive numbers. So yes, 7 and 8 week market cycles are can be susceptible to a short-term correction. If we look further out, 6 months and a year out, they're typically very bullish signs because they're part of a bullish market, right? You don't get 7% market corrections during a bear market, right? That just doesn't happen, right? So um, optimism, there's some optimism here, continued optimism, I would say. And we're aware that, and I'll sorry, let you speak in a second, Tanya. I know I've been rambling, but we're aware that there is an opportunity here, given how much we've rallied over the last 2 months, to see what you and I would call like a healthy correction, something like a 5% or a 10% pullback, which to me is never kind of the end of the world. It gives us an opportunity as portfolio managers, to put some capital to work. If we're legging in for any clients, we could put that capital in. If we have clients that maybe are making contributions to their TFSAs or something, it allows us to put that money to work. Or if we just have accumulated cash in portfolios, those are healthy corrections and a great time for us to do our job, which is add value by picking up stocks that have corrected 5, 10, 20%, 5, 10%. And maybe some stocks are down a little bit more than that, and you could add to the portfolio. So we're not saying don't expect a mini kind of movement in the market in Q1, but we're optimistic for 2024. And I'll pause there. Sorry, Tanya.
No, you don't have to apologize. I think that's exactly, when our clients and our viewers are asking for, our projections, just thoughts on there. But I think it might also be nice to just remind everyone that while corrections like this do present opportunities, one of the things to keep in mind is that as much as it's fun to try to make these predictions or projections, the reality is that it actually doesn't necessarily change for our viewers or, like the approach necessarily. Like it doesn't change, any individual investor's risk tolerance to know that, hey, we're going to have a good year, or we don't think we're going to have a good year. It actually doesn't change the overall approach. And so that's kind of what it's interesting, because I know it's never the answer that people want to hear when they're asking for projections for next year. But my answer is usually, to what extent does that really matter at this point? Would this actually change your approach and I think that you nailed it when you said that, yeah, it does present some opportunities if ever we do get a correction, but overall, it really doesn't necessarily change the strategy to know that, even if we did have a crystal ball and we knew, it could potentially, but it doesn't change our clients' risk tolerance.
What a great point, because it's exactly not what people want to hear, but it is
yeah,
a
sorry
reality.
to be the person who gives the boring answer to the question.
No, because if I think it's a big red flag if you're with an advisor today at another firm and they're
Yeah.
telling you, we're really, really worried about 2024, so we're going to go cash for 40% of your portfolio or something like that.
Yeah.
Or we're really, really, really optimistic, so we're going to sell all your fixed income, and we're going to change your asset allocation. We're going to change your risk profile because we have conviction. That is a red flag. That's a big red flag. Now, it's fine to do some tactical shifting, 5% or something one way or another within kind of a range that makes sense for the client. But any advisor who's telling you that they have an inkling and they're going to make a big shift, it's problematic. Within the asset class is fine, right? You could say we're going, out of private equity and into, music royalties or whatever, and that's fine, but you're still having an asset class that has the same risk tolerance for the client. Just like going from more US to more global stocks is fine, but to kind of eliminate an asset class and to take on more risk or less risk just on a hunch that's a red flag, a big red flag in my opinion.
Yeah. All right, I think we might have some questions here coming up, some specific questions.
Fred's asking a question about alts. What do you see for alts in 2024? So there's a lot of different categories of alts. So first off, we like the alts that we own, pure and simple. And people ask me this kind of all the time. We like the alts that we own. There are some years where alts will do a lot better than the equity markets, like 2022, right? We had a year where alts did, some did 20, some did 15, some did 12, and equity markets were minus a million. And then you have years like this year where equities do really, really well and alts still do their 8 or 9% or whatever. Some do worse, some do 5 or 6, some did 15. We expect the private REIT alts. Some of the private REIT alts have adjusted their NAVs a little bit during this year. We expect those are going to bounce back in good favor in 2024 because interest rates are falling dramatically. And I own a bunch of real estate. Tanya, you own real estate. Reducing interest rates is very, very good. The music royalties is going to do exactly, I think, what it said. It's slightly better returns than kind of the average. So I think they're going to do 10 to 12 is my guess. The farmland, I don't know when. The farmland is poised for an inflation bump at some point in the next 1 to 3 years. It's a lagging indicator. It's always a laggard. So like the inflation happened. We need more. We pay more for our food, and that it needs to make its way all the way down the supply chain. That inflation, it takes a while to get to the actual land, which is the beginning of the production cycle. But at some point it will get there, and when that does happen, farmland will appreciate a lot. The other alts that we have, what do we have? Private equity should do well.
Infrastructure.
Infrastructure is poised for a rebound, I think. What am I missing here? Oh, the storage is going to do well. I do well in my mind is kind of in that 8 to 10% range, very tax efficient. We see zero concerns whatsoever of any of the alts that we own. And if we do see a concern, we address it. We talk to management. We go tour the properties, we inspect, and we get out. And we've done that with some alts in the past, and we did that this year with some alts, and we're very, very proactive when it comes to our alternatives and managing them and what we do. There's a question about energy stocks here. What do you think energy stocks will do in 2024? Well, okay, energy stocks are very, very, very dependent on the price of the commodity, and it's a leveraged play in Canada. So if you have any of these, the smaller you go into the market cap, the size of these companies, typically the more leverage you get. And if you get a dollar movement or $5 movement in the price of WCS or a barrel of West Texas Intermediate, you get like way more amplification in the stock price. So like a 5% move in the commodity might be like a 20% move in the stock price. And the larger cap you go in Canada, the less that leverage is and the less that amplification happens. So I don't think they're going to move in tandem and in unison. But if you look at light crude today at $74 and natural gas at $2.31, that's a bit of a light number, I think, that most forecasters would predict. So I believe that you're going to see a rally here in energy stocks over the next year or two, but I would never manage money with that sole focus because it's a riskier play to take on a whole bunch of assets that are commodity based, commodity driven. So we don't need to take undue risk for our clients. We're not going to do that. We believe we have healthy allocation where it's right for the right clients. We'll have 1 or 2 positions, maybe 3. And we think that if that sector rallies, we'll be well positioned to take a piece of it. And if you were gambling, and you shouldn't be, and you shouldn't gambling with your portfolio, that might be a sector that you could consider loading up on. But I'm not advocating for that, to be clear. I think they're going to rebound. Now, don't go do that without talking to your advisor, Don.
Should we continue the discussion on commodities? I think we have
yes, we do have a
question on gold, if I remember.
Yeah.
And this one, I could always kind of just read it off. This one we got in advance. It was an email,
right?
It was an email. And so someone who's been hearing a lot about investing in gold, and should we get that exposure? How should we get that exposure? Why or why not?
And Diego, you'll put that question up on the bottom as a banner there. But I think the question with respect to buying exposure to the commodity as a whole, those of you that know me know my opinion on this, but I will say it again. I don't buy gold as a commodity, silver, platinum, plutonium. Could you imagine buying plutonium? It reminds me of the scene from Back to the Future where Dr. Brown goes, maybe in your day, Marty, you walk to the corner store and you pick up a vial of plutonium, but in 1955, it's very difficult to get plutonium. Um, so I forget about plutonium, but the other ones, I don't want to own them because they're not assets that pay a dividend. They're not assets that generate cash flow. They're assets that it's kind of like the greater fool theory. The only way I'm going to make more money by owning this asset is if someone pays me more for it at a future date. And that's a risk that I don't want to take with my client's capital. I understand the cycles of gold and I understand that it's a hedge against inflation. I understand that, the more the central banks print money, like I get all that. I've read all those books. I took the courses in my PM licenses and all the years I spent studying this. I get that. It's not an asset. Like I don't want to take that opportunity cost with my client to got 10 or 15% of their assets on the sideline, not generating revenue, hoping for a bump in a commodity price when I can own a quality stock or a quality piece of real estate or a quality asset that is generating cash flow for my clients. So if I were to ever play the commodity cycle, if the way that we do it is we buy companies that deal in the sector and that are profitable. So if you own a profitable company and we believe that gold will appreciate, then we would buy a gold company, a company that produces gold or a company that services gold companies. So that's how we would play it. And I'm not a gold guy. Sorry, it's not what I am. And I think my clients have benefited tremendously from that. Every time we see a portfolio, Tanya, and it's like a whole bunch of gold and a whole bunch of silver in that portfolio, I just think, this client's gone like 20 years without making any money on that,
Yeah.
or making very, very little money on that position. And it sucks for that client.
I think a lot of people also don't even realize that if you are holding gold as a commodity, bullion or whatever, just how volatile that actually is. Actually, it can be just as volatile, if not more, than stocks, except without the upside. So it's a tough argument to make to consistently have it. Especially if you're not getting upside from a well managed company that's either creating income or that's somehow adding value to just trying to essentially make a bet as to whether or not this thing will be worth more in a year or 2 or 3 or 5.
Yeah.
Yeah.
I'll post this because Sylvie Lagancel, I think you would have probably gone to school with her, I think.
Yeah, exactly. Hi, Sylvie.
She just wants to say hello, wish you all New Year's, Joyeux Noël.
Joyeux Noël, Sylvie, puis bonne heureuse année.
Sylvie is president of the St. B Chamber of Commerce, if I'm not mistaken. No, I'm sure of that.
Yes.
She is, and the Chamber of Commerce is doing wonderful things. I used to be president of the Chamber of Commerce, and they're doing awesome things. There's a question on crypto. I'll leave that one to the side for now. I want to get to maybe a couple charts about what we think will happen with inflation, interest rates, unemployment, recession, that kind of stuff.
Yeah, because that's been in the news a lot this year. We're kind of every month we're kind of waiting. Okay, what's the Bank of Canada going to do? What's the Federal Reserve going to do? So it might be good.
This is a chart that shows when the Fed cuts their rates, and do they do it when CPI is higher than the unemployment rate? So this is all the rate cuts over the last 50, 60, we'll call it 65 years. So there have been, 20 rate cuts, give or take. The vast majority of them have happened when CPI year over year is higher than the unemployment rate and not vice versa. So in other words, more inflation than unemployment. When you have more unemployment than inflation, it's problematic, right? Because you can get into that, you're cutting already in a recessionary environment. So it's really, really tough. So right now, December 2023, we are right here. We're on the line. So we talked about Fed cuts. We've talked about Fed cuts a lot. When do we think Fed cuts are coming? The last time that there was the inflation, so the most recent Canadian number came out for inflation. It was a little higher than anticipated. It's still in that 3.1, 3.2 range. So I think on the Canadian side, I think we need to see a 2.5 or something before we start to see the Canadian Bank of Canada cut. On the U.S. side, the Fed, the market is anticipating. I'm going to show you. It's probably this one here. The market is anticipating anyways that, it's this one. I'm going to show a different screen for you guys. The market dropped 110 basis points on the 10-year in like 2 months, right? So the bond yields fell from, they were at we call it 5, and they went to 3.9. So that is a big, 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 big jump, and a jump that we almost never see until the Fed announces they're going to cut rates, right? So usually the 100 basis point decline comes between like, or at the time that the US Fed announces their rate cuts. They haven't even announced a rate cut, and the bond market went, all right, we are done with this. Call it a day. This inflation problem's behind us. And I think that is wrong. So I disagree with anyone who thinks that they're going to start cutting like in March and it's going to be aggressive and I think you need to pump the brakes a little bit, because we need to get that inflation in the 2.5 range before we start cutting interest rates. So yes, mortgages, interest rates have fallen a ton, and that's very good if you own a mortgage and you're renewing right now. Probably a good time to be locking in for another 5 years potentially. So like consider that, because I think that this might have been too much too soon. And I said this on BNN a couple of weeks back, but that was a very aggressive move by the bond market when nothing really happened. What did Jerome Powell say? He said, we're watching things closely and we're going to proactively cut this. And historically, it's never gone this way. And all of a sudden, we got really giddy this time, really excited, really, really excited. So I don't think that you should expect rate cuts. This is my call, towards kind of the second quarter, tail end of the second quarter, or the second half of next year. And I think the market's anticipating like 5 cuts, but the US Fed is kind of said that they're going to get 3 cuts. So someone's wrong there, right? So the market's anticipating more cuts than the US Fed is saying. So all this to say, we've been waiting a very long time for these interest rate cuts. They are coming. I promise you they're coming. Just, pump the brakes a little bit. They're coming. Just, it's kind of like telling my kids, Christmas is coming. Like, don't worry, the Santa's going to have the gifts under the tree, and like they're coming, but just, it's not today. It's not tomorrow. So that's my take on that. And I don't know what you think on that, Tanya.
Well, I think that's absolutely right. There was this, like, I think giddy is a good word. It's almost like there was this palpable kind of like excitement, like people were like waiting to like pull the trigger or something, and all it took was like a kind of optimistic kind of half sentence from Powell, and it really didn't take much for people to really interpret it in a big way. And which is interesting, because I don't know how long this cycle was in comparison to previous ones, like in terms of how long the interest rate hikes lasted before they start cutting in comparison to like previous cycles like this that we've had. But it felt like people were just, let's get out of this right now.
Yeah, I think it's actually, I believe it's actually shorter. Like, I think people are less patient.
Yes,
than they
I
have
would
been in
agree.
the past.
And maybe it's just because the world is even more interconnected now, and the markets seem less patient. The market seems to just be pricing things even further out, it seems.
I'll show you one here that I like. It's this one. It's how quickly the 100 basis points fell from the first.
That's exactly what I was wondering. Perfect.
Yeah. So these are 3 different scenarios: 1988, 89, 1999, 2000 in the middle, and 06, 07, 08. And they talk about the Fed cuts and when the market. So there's 2 different. This is complicated, and sorry if I lose you. Hopefully I don't lose you guys. But when the market prices in a cut, so in other words, the bonds trade, right? They trade on an everyday basis, and the Fed is saying one thing, but the market is doing another thing. And the US Fed might say we're going to cut next year, but if the bond market's anticipating that, they might cut right away. And this is 100 basis points drop in 89. It happened, kind of 1 month before the first cut. In 2000, it happened 2 months before the first cut. And in 06, it happened 1 month before the first cut. It happened in November. So like we're at least 5 months, I think. 4 months at an absolute minimum. There will not be a cut before March. That's not happening. So at least 4 or 5 months before the first cut. So like really antsy market. And then usually the next 100 basis points, yields usually do not fall more than 100 basis points below the peak Fed fund rates before the first cut. And then usually the next 100 basis point cuts come between the third and the fifth cut. So like the bond market is pricing in. So I think it'll have to normalize itself, and that's okay. Like it's fine. But just don't anticipate that we're going to go straight back to zero interest rates, now. Like this needs to work its way through the market. Hopefully that made sense.
Absolutely.
I wanted to show a couple more things here about, and then I know there's questions, but I want to get to my charts that I prepped for this because I thought I would show off some charts. This one is a bit of an indicator as to what 2024. So I thought this was very interesting. 82, the comparison between 82 and 2023. Remember, 82, we were coming off crazy inflation, crazy interest rates. So Volcker was the US Fed, who's often regarded as kind of a guru and a whiz kid. Wasn't a kid, but as a wizard, how he handled the inflation. I mean, interest rates went to 20%, so I don't know if it was that good, but between the trough of the S&P 500 and when they declared victory against kind of inflation, there was 37 days in there and they went up 19%. We had that 14% rally kind of in October, November. And then what happened after that? Powell kind of, you said it, one sentence, kind of half declared victory. Well, the next 12 months were actually ongoing continued strength. And I think we'll see that. That's why, you're asking me, one of your first questions, what are we going to see in 2024? It might not be as smooth as it was in 82, but I think up, down, up, down, up, down, continued strength is what I would expect over the next while. And then this is just a friendly reminder, the market cycle. Okay, reminder, the market cycle. This is 7 years depicted here. It's basically 2 market cycles. So this was a rally here. The black line is our current market. The blue line is the average. And then all the other ones are 2020, 2009, 02. They're the most comparable markets to the ones that we've had. Well, we're on pace here with, if September 2022 was kind of the bottom of the market, which this index has been rebased, here are the different markets 4 years out and what it looks like. So we believe at Canaccord, through our technical analysis and our researchers, that we're kind of in the midst of a market, like the start of a new market cycle. So that would mean 3-4 years sometimes is how long they go, 5 years, whatever, of ongoing bullish market trends. And this is that image, the image of the market cycle and what has happened historically. So I wanted to share that. I think that's my last chart. No, cut one more here and then I'll stop. I promise, Tanya. This is the percentage of stocks overbought. And this might feel like stocks that are overbought is a bearish indicator. It's actually not. It's actually a bullish indicator because the markets tend to rally after it's positive momentum. So we are at a comparable number to June 03 and June 2020. This is a week old already, this chart. So that means, okay, another thing I want to say here, and then sorry, but I just have all these thoughts. There are so many people that have called us in October, November, December, and have told us this has been a lot of gains in the stock market, right? Should we maybe just put 20, 30, 40% in cash? Like, why don't we just do that? Why don't we do that, right? Why don't we just, we made a lot of money. Here's why we don't, right? The market is very momentum based. And a lot of times, if you just happen to miss the best week of the year, well, I know this for a fact. If you miss the best week of the year, you're negative over the last 20 years. You have negative returns if you miss the best week of the year. So like if you miss the best 2-3 days of the year, you could just dramatically kill your returns, right? And if you miss the best month of the year, like you're getting destroyed. So why do we never make that call when the markets are momentum-y? Is because we had all these reasons for positive momentum. We don't want to get in the way of this market, right? We want to continue to own quality assets. We don't want to speculate. We're not going to gamble owning an asset class that doesn't generate cash flow, but we want to make sure we continue to own quality. And coming into December, I said it many times, those of you that have listened to me, you want to be invested in December. December is a very good month. You get the Santa Claus rally, and maybe I should explain what the Santa Claus rally is, but historically it's the 5 last trading days of the year and the 2 first days of the following year. So the 7 trading days on average, it's 1.5%, just in that on average over the last 50 years, I think. So 1.5% on average. I'm not saying it's going to happen every year, but why would you not want to be part of that rally? And the thing is, we know why it happens. It happens because people are in a good mood. They're going home. They're having wine with their friends and their family, and their kids are happy because their kids got the gift or whatever. I'm in a good mood around Christmas. I know you're in a good mood around Christmas, and when people are in a good mood, they tend to buy more equities. They tend to not call their broker and say, sell all my stuff. It typically doesn't happen that way. You've never seen a crash between Christmas and New Year's. I don't think it's ever happened. Someone can correct me if I'm wrong, but you might have seen a negative day here or there. But like, why would we not be part of that rally? Yeah, you might not get it this year. It might be minus 1% or 2%. But on average, if we can get 1.5% during that week and a half, we want to be there. So, anyways, we are not going to make that call to be like, let's avoid this. So I think of all those individuals out there that have definitely taken some profits and sold and said, I'm going to wait this out. Well, they missed like 10% rally here over the last month.
Mm-hmm.
It's crazy, right?
This is also what we've been waiting for the past 3 years. This is, how many times do we have to kind of explain, also to kind of, walk people off a ledge, in 2022? Well, this is it. This is what we were waiting for in 2022. So why would you not want to be part of it, right?
Yeah. Yeah. And we're not always going to be right, but I mean, we know that we have to manage our clients' money as a steward of their wealth and to protect their capital based on every piece of information that we have. And that's the only thing we can do. And that's what we're going to continue to do for our clients always, at all times.
Love it. Love the Santa Claus rally.
Yeah. And I mean, who knows? It might not happen, but I think it will.
Well, kind of see there's a lot of green on there today.
Yeah.
So
And you know what?
I haven't seen much red at all in the past.
We had a 500-point minus day last week. Remember that? I think it was like
Mm-hmm.
Wednesday, or was it
Yeah.
Tuesday or Wednesday? And like,
But one day, that's all.
Yeah, we lost 1.5%. Well, we're already way above that. Like 500 points is a big down day, right? It's pretty negative. And I was just like, maybe I'm too lackadaisical about this. I was like, that's noise. I remember just being like, that's noise. That's not going to matter in a week, in 2 weeks. Trust me, that's not going to matter. And here we are today already, beating that and at or near all-time highs.
Yeah. Well, I mean, with our jobs, we really do have to constantly be taking a step back. We have to see see the forest through the trees. I keep forgetting that expression. So one day down a few hundred points, like zoom way out, right? So that's why it's kind of nice to see these charts, actually.
Zoom out. I like that expression. I don't think I've ever used that, but I'm going to add that to my.
Like the 100-foot bird's eye view. I don't know. I'm sure there's lots of different expressions. Yeah, you got it.
There's a question here on crypto. I'll address it real quick and then I'll move on. XRP, I believe you're asking about Ripple. I'm just going to address crypto as a whole. Crypto as a whole, I think we rarely touch it, and we sometimes add it as a small asset allocation, 1%, 2%, 3% max for clients, for the right clients that understand and appreciate risk and are able, because it could go to zero, right? That's one of those asset classes that could go to zero. I just said I didn't buy gold for the same reason. So, we got to. Now it's done well for our clients, but I do think if you believe in the waves, the crypto waves, what happens is they have their supply every 3 or 4 years or something like that, or every 2 years or something like that. I'm not a crypto expert, but I'm not pretending to be one. Check out.
There's a crypto market cycle that lasts like a few years.
Yeah, they have the amount of supply. Yeah, so it used to be, I don't know, I'll say 10,000 Bitcoins, or 10 million, or 5 million, or 1 million per year, and now it's half of that.
Okay.
So like there's way less supply. It's a supply and demand question. And if the demand stays the same, if countries start using it and whatever, in theory, crypto could appreciate. I'm not an expert. I'm not making that call, but the charts charts look good for whatever that's worth.
And it was a good year for, I think, almost all of the,
Yeah.
yeah.
Our preferred crypto remains Ether, Ethereum, just because of the the uses behind it. But that's it. That's all I'll say about crypto. Do this, like any dollars you put into crypto, make sure you're okay with it going to zero, because it can happen, and it has happened, and it might happen. Question here about planning on doing more interviews with alt managers. Yeah, absolutely. Like, subscribe the channel if you haven't already. Make sure to follow the channel, and we post regular content here. We kind of try to do three things. We kind of do short form videos, we do kind of value videos, kind of 5 to 10 minutes, where we try to explain a topic, and then we do these longer form videos where it's me and Tanya, or me and my dad and Tanya, or maybe we'll get my brother on someday and he can argue with us the entire
Our
hour.
time.
Yeah, it'd be
Yeah.
so fun, right?
You asked about Christmas traditions. That should
Arguing
be
with
like,
my brother.
yeah, arguing with Charlie.
Yeah, it's so fun.
This year the argument was all about nasal breathing. That was the year that we
Tanya, nobody nose breathes. Nobody that's a good runner nose breathes. So you're wrong. I hope he doesn't watch this, because then he'll know we're chirping him, or maybe. And then we also do long form interviews with CEOs and alt managers and people that we think will bring value to our clients to understand a little bit more about their asset classes. A couple more questions here.
And if you have any more, we're on for a few more minutes, so last chance to post questions, comments.
Okay, here's a question about utilities. Prices down, big dividends. Yeah, Canadian sector has been historically a place where utilities are a proxy for bonds, right? So they pay a very high yield. There's very little capital appreciation because most of the profits get distributed, so you don't get a ton of appreciation. So historically, when bond yields have gone up, the utility stocks are worth less. So this is like a bond trade. If you're buying utilities, you are hoping and expecting that the market yields on the 10-year will go down more than the market is expecting. That's a little complicated, but basically we all know that interest rates are going to go down. So the market is pricing that in, right? So if you look at a utility stock, the market is saying, yeah, but that'll be more valuable in 12 months when interest rates go down. So if you're buying a utility stock today, you're saying, I expect that the market is wrong and it'll go down more than that. Or you're just confident owning the yield and you're kind of indifferent if it goes up or down, because they are paying really nice yields right now. So I think utilities have a good place in portfolios for a couple of reasons. The Canadian yield and a non-reg, it's very tax efficient. I wouldn't have overweight exposure by any stretch, but it definitely makes sense in certain portfolios. Same thing with this question from Steve. Exact same thing, a little bit less aggressive. Telcos are a hybrid of utilities. So if we look at the scale of where you would put a bond and where you would put a growth stock, in the middle there you have a Canadian bank somewhere.
I was just gonna ask, where do the financials fall in there?
Insurance
Right
company.
there. Okay.
Insurance company right here. Telcos.
Uh-huh.
And then utilities, and then bonds. So they're a proxy, much like those utilities. They are a proxy for yield, right? Because telcos have historically paid a high yield. Now the problem with telcos is you have a way more operating risk, way more operating risk. So do you trust that TELUS and those companies are going to be able to navigate the highest cost data, and is that going to continue? And do you think Canadians are going to put up with that for a long time, or do you see a trend that potentially our cell phone bills could get cheaper? The most recent inflation number, again, I'm not an expert in telco, this specific topic specifically, but I'm just saying that the most recent inflation numbers were minus 20% year over year for cell phone bills. So I've noticed, I the other day I was like, Marco, what's my cell phone costing me? And he's like, we looked into it and it was very expensive, way more than I thought I was paying. So I'm like, what are you paying? And he's like, oh, I'm paying like half of that. And I was like, huh. What do you
A
have?
lot of
It's like,
people are doing it. I switched too. I was like, why am I paying this and I could get the same thing for half the price? So
yeah,
some consumers may start shifting and be
yeah.
like, hey, I don't know
That's
if I want to pay $200 for my cell phone anymore.
that's the risk with telcos, and I don't think
Yeah.
it's the same with utilities. My preference would be on utilities, but that's reflected in the market, right? If you look at the chart for telcos, um, they're down, right? And they reflect that, right? So
Mhm.
I think, I'm not giving advice here as to what stock to buy or sell. I'm just talking about it generally. Got another comment here from Mahmoud. Thank you for sharing. Happy holidays, Rob, and everyone. Always great learning something new in these market recaps. We look forward to a fruitful and prosperous new year. Oh, thank you. Um, okay, so I think I'm going to wrap it up, or should we take one more, Tanya?
Let's do one more and
Okay.
then we can wrap it up. Last one.
Okay, this question here, I'm not sure I understand the question, Carl. Uh, Portfolios generally, or are you
Mhm.
asking about our clients' portfolios? If I think generally, I would say the answer is probably uh, cyclical commodities. Well, I'll tell you what I typically see when we see statements. We see a lot of statements. Tanya and I see a lot of statements. Tanya, Rem, and myself see a lot of statements, and we often see them like overweight Canadian equities. Wouldn't you say,
Yeah.
Tanya?
Yeah. And when that's the case, what are you going to see in Canadian equities? This is exactly the
Canadian
types of
banks,
commodities. Yeah.
insurance, telcos,
And then
utilities, and commodities.
energy, oil and gas. Yeah, exactly.
So we see statements all the time where like clients are 80% exposed to Canada, 90. We see some still, I don't know how this is possible, 100% exposed to Canadian stocks in their stock
Mhm.
portfolios. And I'm thinking like, how much money has this client lost over the last 10, 15, 20 years by not having a diversified portfolio?
Mhm.
Canada's 1.6% of the global GDP, and yet you're going to put all of your clients' wealth in like 20 Canadian stocks. I just don't
At
get
first
that.
glance, it seems so risky that
Yeah.
to not diversify from a geographical perspective. So yeah,
But
in general, that could potentially be the case. That in general, especially in Canada, you could
I
potentially see some overexposure.
I don't think though. I think I think oil is so taboo right now. Like owning oil stocks is taboo, and it's not well seen, and there's a lot of what is it, divesting
Mhm.
of oil at the institutional level, at the university level, the endowment funds. So, and I think like regular Canadians are starting to make that decision too. So I don't think that overall as a Canadian, as a country, we are overexposed to cyclical commodities, unless you live in Calgary. Yeah, because I'm guessing they've got a lot of stocks in their backyards if you live in Calgary. So we're certainly not, definitely not, and I don't think Canadians are as a whole either. To answer that question, Tanya, we're gonna wrap it up or what?
I think we're going to wrap it up. We said this was the last one. Thanks so much for joining us, everyone, especially between Christmas and New Year. I'm so happy that we're actually able to get some questions and people were able to join us. So, once again, Happy New Year to everyone. Hope you still get a little bit more time with friends and family over the next couple of days. And thanks for joining us.
Happy New Year.